The Iran war inflation shock. There's a choke point in the Persian Gulf roughly 33 kilometers wide at its narrowest point. 1/5 of the world's oil passes through it. For decades, economists called it a theoretical risk. On February 28, 2026, it stopped being theoretical. The United States and Israel launched a joint military operation against Iran. Iran closed the Strait of Hormuz. And within 30 days, Americans were paying for it at the pump and everywhere else. This is the story of how one military operation became an inflation event, and why the economics were predictable to everyone except, apparently, the people who launched the operation. The Strait of Hormuz. The Strait of Hormuz is not a strategic asset in the way a military base is a strategic asset. You cannot bomb it into irrelevance. You cannot sanction it away. It is a geographic fact, a narrow channel between Iran and the Oman Peninsula, through which approximately 20% of the world's traded oil passes every single day. When Iran announced the closure of the strait in early March 2026, the International Energy Agency called it the greatest global energy security challenge in history. The 1973 Arab oil embargo, the 1979 Iranian Revolution, the Gulf War. None of those events blocked this particular choke point completely. This one did. When 20% of global supply gets disrupted, every barrel of oil that exists on the planet immediately becomes more expensive, whether or not it ever went anywhere near the Strait of Hormuz. By March 2nd, Brent crude had jumped 10 to 13% to around $80 to $82 per barrel. By early April, it was trading at approximately $96 per barrel. The United States produces a significant share of its own oil. Domestic production insulates the U.S. economy from import disruptions. What it does not insulate it from is the global price mechanism. American oil companies sell their oil at world market prices. So when Iran closes the strait, the price of Texas crude goes up too, not because of what happens in the strait, but because of what happens to the number on the global benchmark. The people who benefit and the people who pay are almost completely different groups. The gasoline price spike. On February 26, 2026, the average price of a gallon of regular gasoline in the United States was $2.98. On March 31st, it was $4.02. That is a 35% increase in 33 days. By April 10th, it was $4.15 nationally. On the West Coast, specifically California, it was $5.87 per gallon. Today, April 10th, 2026, the Bureau of Labor Statistics released the March Consumer Price Index. The number, 3.3% annual inflation, up from 2.4% in February. The monthly CPI increase, 0.9%, the largest single-month jump since June 2022. The gasoline index rose 21.2% in a single month. The Bureau of Labor Statistics noted this is the largest monthly increase in gasoline prices since it began tracking the data in 1967. That is 59 years of records. Gasoline is the most visible price in the economy. You drive past it every day. It is printed on a sign. When that number moves, it moves psychology immediately. But gasoline is also not the only thing oil prices affect. It is just the first thing. The second, third, and fourth things are still arriving. The transmission mechanism. Oil is not just what goes in your car. It is the feedstock of the modern economy. Diesel powers the trucks that move goods. Diesel hit $5.68 per gallon on April 10th, up from $4.78 a month prior, a nearly 19% increase. Every company that ships anything by truck is now paying more. Eventually, they charge more. Eventually, you pay more for the thing inside the truck. Jet fuel powers the aircraft that move people and packages. Jet fuel in North America spiked approximately 95% since the war began. Multiple airlines raised baggage fees in response. Airline fares rose 2.7% in March alone. Fertilizer is made partly from natural gas, which is also disrupted. Qatar, one of the world's largest LNG exporters, had its Ras Laffan industrial complex hit on March 18th, causing a 17% reduction in Qatar's LNG production capacity. LNG spot prices in Asia reportedly increased over 140%. Without affordable fertilizer, food production costs go up. Without cheap diesel, food transportation costs go up. Food prices in March were flat, but analysts and farmers are already warning that this is a lag, not a reprieve. The U.S. Postal Service added an 8% surcharge on some packages because of higher fuel costs. Energy shocks do not arrive all at once. They transmit through the economy in a sequence. The gasoline spike is week 1. The diesel into trucking pass-through is month 2. The fertilizer into food spike is months 3 and 4. The BLS data released today is capturing the first wave. In other words, the 3.3% number is not the destination. It may be the departure gate. The Strategic Petroleum Reserve. The U.S. government is not completely helpless here. It has tools. It used them. President Trump ordered the Department of Energy to release 172 million barrels from the Strategic Petroleum Reserve. He waived the Jones Act for 60 days, allowing foreign flagships to move goods between American ports. He allowed the sale of higher ethanol gasoline blends normally banned in summer for environmental reasons. These are the standard tools. They work on the margins. The Strategic Petroleum Reserve, at its peak capacity, holds approximately 714 million barrels. The U.S. consumes approximately 20 million barrels per day. A release of 172 million barrels, delivered over roughly 120 days, amounts to approximately 1.4 million barrels per day, about 7% of daily consumption. It takes the edge off. It does not close a choke point. The EIA forecast that retail gas prices could remain elevated until at least end of Q2, and only fall back toward $3 per gallon by year-end. That forecast rests on the assumption that Strait of Hormuz traffic improves. A 2-week ceasefire between the U.S. and Iran was announced on April 8th. After the announcement, oil benchmark prices dropped almost 15%, but still remain 43% above pre-war levels. Analysts said consumers should not expect pump prices to fall below $4 per gallon for at least several weeks. The ceasefire is 2 weeks long. It was announced by a president who called the disruptions short-term while simultaneously releasing almost a fifth of the strategic reserve. The gap between the reassurance and the action is itself data. The Fed's box. Before the Iran war, the Federal Reserve had penciled in one interest rate cut for 2026. That projection is now canceled. The Fed's job is to control inflation without crashing economic activity. When inflation is high, you raise rates to cool spending. When economic growth is sluggish, you cut rates to stimulate it. What do you do when you have high inflation and a slowing economy simultaneously? That combination has a name, stagflation. It was last seen prominently in the 1970s, also triggered by an oil shock. The Fed held rates steady at its March meeting. Minutes from that meeting suggest some policymakers are considering whether a future rate hike might be necessary. Oxford Economics forecast that headline CPI could reach above 4% by April. The Federal Reserve Bank of Chicago president described the situation as a 1-2 punch. First tariff-driven inflation in 2025. Now, war-driven energy inflation in 2026. The Fed has limited capacity to respond to a supply-side inflation shock using demand-side tools. Raising interest rates will not reopen the Strait of Hormuz. It will, however, make mortgages more expensive and slow down a consumer base that was already, in the words of one economist, running on fumes. Who pays? American consumers collectively paid an additional estimated $8.4 billion in fuel costs in the first month after the Iran war started. That is the first wave. The second wave, higher food prices, higher airfares, higher shipping surcharges, higher mortgage rates at the Fed reacts, has not finished arriving. Higher gasoline prices are a regressive tax. Lower-income households spend a larger share of their income on fuel and food. They have less capacity to absorb cost increases. They do not own oil stocks. When an energy shock happens, the population that benefits from higher oil prices and the population that suffers from higher fuel costs are not the same population. Europe is absorbing this differently and worse. European gas storage entering the conflict was at approximately 30% capacity following a harsh winter. Dutch TTF gas benchmarks reportedly nearly doubled to over €60 per megawatt hour by mid-March. The European Central Bank postponed planned interest rate reductions, raised its 2026 inflation forecast, and cut GDP growth projections. Economists warned that energy-intensive economies, including Germany and Italy, could enter technical recession by end of 2026. China, India, Japan, and South Korea collectively receive approximately 75% of oil exports and 59% of LNG exports that transit the Strait of Hormuz. The economic consequences for import-dependent Asian economies are, at this point, still being calculated. Here's what you now know. A 33-kilometer-wide waterway sits at the intersection of global oil supply and global economic stability. It has always sat there. Everyone knew it. The entire architecture of post-Cold War energy policy was quietly organized around the hope that no one would ever actually close it. Someone closed it. U.S. CPI rose 0.9% in a single month. Gas hit $4.15 a gallon nationally, $5.87 in California. Diesel hit $5.68. A ceasefire was announced. Oil prices are still 43% higher than before the war. The second wave of price increases through food, freight, and airfares has not finished arriving. Whether this becomes 1970 stagflation or a containable shock depends on how long the ceasefire holds, whether the strait reopens, and whether the Fed can thread a needle that has not been successfully threaded in 50 years. You will find out at the pump before you find out anywhere else.